Good afternoon. We are looking at a significant dislocation in the healthcare sector today, centered squarely on UnitedHealth Group. Shares of the managed care giant have come under intense pressure during today's session, Tuesday, January 27th, recording a double-digit percentage decline that has weighed heavily on the Dow Jones Industrial Average. For a stock that has historically been viewed as a defensive cornerstone of the market, a safety trade for many institutional portfolios, today's volatility is striking. In this video, we are going to cut through the noise. We will break down exactly what was released to the market this morning, separate the confirmed financial data from the regulatory speculation, and look at why the market is repricing the risk profile of the entire managed care industry. As always, our goal here is context, not prediction. Let's look at the numbers. Two distinct events collided this morning to drive today's price action. Note that figures referenced here are approximate and based on initial market reporting. First, and perhaps most critical to the long-term thesis, is the regulatory news from Washington. Late yesterday, the Centers for Medicare and Medicaid Services, CMS, released its advance notice for the 2027 Medicare Advantage payment rates. The headline number here is a proposed effective growth rate of just 0.09%. To put that in perspective, the market and many sell-side analysts had been modeling for a significantly higher adjustment, with some expectations ranging closer to a net effective increase of 1% to 2% to keep pace with medical cost inflation. When you factor in the rising cost of care, what we call medical cost trend, a 0.09% nominal increase is being interpreted by the market effectively as a rate cut in real terms. This impacts the forward-looking profitability of UnitedHealthcare's massive Medicare Advantage book of business. Second, we have the company's fourth quarter 2025 earnings report, released before the bell this morning. The results themselves were mixed, but they confirmed the margin pressures investors have feared. Revenue came in at approximately $113.2 billion. While this represents year-over-year growth, it fell short of street consensus by roughly $500 million. Earnings per share were reported at $2.11 on an adjusted basis, which was largely in line with expectations. However, the metric that caught the market's attention was the medical care ratio, or MCR. This ratio measures the percentage of premiums spent on medical claims. UnitedHealth reported an MCR above 92%, a notable increase from prior periods. When you combine a miss on the top line with a rising cost structure, that high medical care ratio, and an unfavorable regulatory outlook from CMS, the algorithmic reaction was swift. The stock opened significantly lower and has struggled to find a floor throughout the session. Now, let's look at how the market is interpreting these facts. Why is the sell-off this aggressive? Investors appear to be pricing in three specific risks. The primary concern is structural, the margin squeeze. For years, the investment thesis for UnitedHealth was based on predictable margin expansion. The market is currently grappling with the realization that medical costs are rising faster than government reimbursement rates. The CMS proposal of 0.09% suggests that the government is tightening the purse strings just as utilization, people going to the doctor and getting surgeries, is accelerating. Investors are asking, if costs are up and payments are flat, where does the profit growth come from in 2026 and 2027? The second driver is guidance credibility. While the company provided guidance for 2026, the revenue outlook came in softer than many analysts had modeled. When a company misses on revenue and offers tepid guidance immediately following a year of volatility, remember the cyber attack disruptions we saw in 2025, it can rattle confidence. The market may be applying an uncertainty discount to management's future projections, essentially waiting for proof of stabilization before giving the stock credit for future growth. The third factor is sector contagion. It is important to note that this is not just a UnitedHealth story. We are seeing sympathetic selling across the board. Humana, CVS Health, and Centene are all trading lower. This suggests the market views the CMS rate proposal as a systemic headwind for the entire privatized Medicare industry, not just an execution issue at UnitedHealth. In moments of high volatility, rumors often circulate. It is crucial to be disciplined about what we do not know. First, regarding the CMS rates, the 0.09% figure is a proposal, not the final rule. There is a standard lobbying and comment period that follows this announcement. Historically, final rates released in April have sometimes improved from the advance notice, though there is no guarantee that will happen this cycle. Second, despite the sharp price decline, there has been no announcement of any new undisclosed regulatory enforcement action or fraud investigation today. While the sector has faced scrutiny from the Senate and DOJ in the past regarding billing practices, today's move appears strictly tied to the economics of the rate announcement and the earnings print, not a new legal bombshell. Finally, we have not heard any signals from the company regarding a shift in their capital allocation strategy, meaning their dividend or share buyback plans, although analysts will certainly be probing that in the coming days. To place this in context, UnitedHealth Group has rarely experienced single-day declines of this magnitude. For the better part of a decade, UnitedHealth Group was characterized by low volatility and consistent beat-and-raise quarters. However, the environment changed over the last 18 months. The sector has been dealing with what we call utilization spikes. Essentially, the post-pandemic return of patients seeking elective surgeries and care they had deferred. Historically, when the managed care sector faces a rate scare from CMS, we often see a period of compressed valuations followed by a recovery if the companies can demonstrate they can cut administrative costs enough to preserve margins. The difference this time, and what investors are weighing heavily, is the starting point. With the medical care ratio already elevated above 92%, the company has less room for error than it did in previous regulatory cycles. Why does a drop in UnitedHealth matter if you don't own the stock directly? First, because of its sheer size. UnitedHealth is a price-weighted heavy hitter in the Dow Jones Industrial Average and a top holding in the S&P 500. A move of this magnitude drags down the headline indices, impacting passive flows and sentiment across the broader market. Second, UnitedHealth is often viewed as a proxy for the entire U.S. healthcare system. It owns Optum, which manages pharmacy benefits, data, and direct patient care. When UnitedHealth signals that medical costs are surging and government payments are tightening, it might send a warning signal to hospital stocks, medical device makers, and pharmaceutical companies. It suggests the payer environment is getting tougher, which could lead to tighter negotiating on prices across the whole ecosystem. To recap, UnitedHealth Group shares are down sharply today following a Q4 earnings miss on revenue and a disappointing Medicare Advantage rate proposal from CMS for 2027. The market is currently repricing the stock to reflect a potentially lower margin environment for government-sponsored healthcare. While the company remains a cash flow giant with a massive footprint, investors are digesting a new reality where growth may be more difficult to come by in the near term. For now, markets are digesting this information rather than reaching final conclusions. We will be watching closely to see if the final CMS rates in April offer any relief. This content is for informational and educational purposes only and does not constitute investment advice. Investors should conduct their own research or consult a qualified financial professional before making any investment decisions.